All right, let's talk about Ethereum's November. Man, what a month. If you were holding ETH, you went through a pretty brutal storm. One minute, things look stable, and the next, bam, full-blown crisis. So the big question is, was this just a classic market panic, or is there something, deeper going on here? We're going to break it all down.
So how bad was it? Well, the month kicked off and the floor just completely fell out from under the market. We're talking a staggering 28.4% drop in just a few weeks. A move that sharp, that fast, yeah, that gets everyone's attention, and definitely not in a good way.
Let's put that percentage into real money terms because that's what really hits home, right? We're talking about $1,000 wiped off the price of a single ETH. It went from a pretty healthy-looking $3,600 and just tumbled all the way down to around $2,600. I mean, that's hitting lows we haven't seen in months.
So, a drop like this, it forces you to ask some really tough questions. What the heck just happened? Was this just the market doing its crazy, panicked thing? Was it a reaction to something happening in the wider world? Or, and this is the scary one, was it a sign of real trouble inside Ethereum itself? Well, that is exactly what we're going to dig into.
Okay, first up, anatomy of a sell-off. To really get what happened, we need to dissect this thing, because it wasn't just one bad day or one piece of bad news. No, this was more like a perfect storm of a bunch of different pressures, all hitting the market at the exact same time. So what was in that perfect storm? A whole mix of things, really. You had big picture economic fears, Fed policy jitters. Then you had the big institutional players starting to pull their money out. That triggered a nasty cascade of forced selling. And on top of all that, there were worries about a bubble in the AI space that kind of spilled over. Let's tackle these one by one.
And you can almost pinpoint where the fear started. It was this quote from Fed Chair Jerome Powell. All he had to say was that future rate cuts were not a foregone conclusion, and boom, the markets got spooked. When the Fed sounds even a little bit uncertain, investors get nervous and they go into what's called risk-off mode. That means they sell stuff like crypto and run for safer, less volatile assets.
And boy, did the big institutions follow that mood. We're talking about almost $500 million flowing out of the spot Ethereum ETFs in just 1 month. Now, why does that matter? Well, these ETFs are the easy on-ramp for traditional finance, for the big money. So when you see them pulling out cash on this scale, it's a huge red flag. The same players who were bullish just weeks before were suddenly sprinting for the door.
Okay, and this is where a manageable dip turned into an absolute nosedive. Almost $1 billion, in leveraged positions got completely wiped out. And the key thing to understand here is that these traders weren't choosing to sell, they were being forced to sell by the exchanges because their positions went underwater. It creates this vicious, self-feeding downward spiral. And there's a specific name for that.
It's called a liquidation cascade. And you really got to get this concept to understand the crash. Think of it like a line of dominoes. The price drops a bit and it hits a trigger point, knocking over the first domino. That's a leveraged trader getting automatically sold out. But that selling pushes the price down even more, which is just enough to knock over the next domino, and the next, and the next. It's a chain reaction, and it's what turns a small fire into an inferno.
So, okay, that's the panic story in a nutshell. You had retail traders just capitulating, the fear and greed index was screaming extreme fear, it was chaos. But, and this is a big but, this is where the story gets really interesting. Because while all that was happening on the surface, something very different was going on underneath. Let's pull back the curtain.
All right, section 2, strength beneath the surface. This is key, because while the price chart looked like a horror movie, Ethereum's actual fundamentals, well, they were telling a completely different story. A story about real conviction, about long-term strength that all the noise on social media and in the headlines just completely drowned out.
And honestly, this right here tells you pretty much everything you need to know. It's a tale of two traders. On one side, you've got your retail investors, the little guys, understandably panicking and selling off. But on the other side, you have the whales, the massive wallets. And what were they doing? The complete opposite. They weren't just holding on for dear life, they were aggressively buying. We're talking about them scooping up more than $1.3 billion worth of ETH in 1 week. 1 week.
And that conviction, it goes even deeper than just buying. Check this out. The total amount of ETH locked up in staking hit an all-time high. We're at nearly 30% of the entire supply. Now remember, this isn't money that's sitting on an exchange ready to be sold at a moment's notice.
No, this is people willingly locking their ETH away for the long haul to help secure the network. It is the ultimate vote of confidence in Ethereum's future. And then there's this little piece of news, which is maybe the most incredible part of the whole story. Right in the middle of all the chaos and crashing prices, something huge and positive happened. The SEC in the US finally delivered a landmark ruling that basically took away the single biggest regulatory risk hanging over Ethereum's head, the threat of it being labeled a security. This was monumental news, the kind of thing the community had been waiting years for, and it got completely buried by the panic.
So you've got this weird situation, right? Terrible price action, but rock-solid fundamentals. The question is, what could actually turn the ship around? Well, that brings us to the next big catalyst on the horizon, Ethereum's next massive evolution, the Fusaka upgrade.
So what on earth is Fusaka? The simplest way to think about it is like a massive supercharger for Ethereum's layer 2s. You know, the networks like Arbitrum and Optimism, where most of the action happens. It's designed to give them a huge boost in data capacity. Now, what does that mean in plain English? It means it gets way, way cheaper for apps to run on them. And the best part? Those savings are expected to get passed directly to you, the user. We're talking potential fee reductions as high as 95%. That's a game changer.
And why is that such a big deal? Well, just look at where the action is. The majority of all Ethereum transactions, almost 60%, are already happening on these layer 2s. So making them radically cheaper isn't just some small technical tweak. It's a direct, massive upgrade for the experience of most people who actually use Ethereum every single day.
So all of this puts Ethereum at a real crossroads. On one hand, you've got a terrified market driven by macro fears, and on the other, you have incredibly strong fundamentals and a game-changing upgrade right around the corner. So with these two forces pulling in opposite directions, what happens next? Where do we go from here?
Well, if you look at what the analysts are saying, there are basically three potential scenarios playing out. You've got the bull case. Fusaka is a huge success, the Fed chills out, and we head back towards $4,000. Then there's the bear case. The economy stays gloomy, money keeps flowing out, and we could see prices drop down to around $2,100. And finally, the base case, which is kind of the middle ground. The market just chops around for a while, consolidating and trying to figure out which way to go.
And the crazy thing is, we're probably going to find out which path we're on very, very soon. There are two huge dates you need to circle on your calendar. First up is December 3rd. That's when the Fusaka upgrade is set to go live. Then just a week later, we have the final Federal Reserve meeting of the year. What happens during those two events is likely going to set the tone for the entire start of 2026. And that really leaves us with the ultimate cliffhanger, doesn't it? What's going to win this tug of war? Is it the short-term market fear driven by headlines and interest rates, or is it the long-term fundamental value that's literally being coded into the network as we speak? The answer, one way or another, is coming very soon.